There we go. All right. Tori Alden.
Hello, everybody. Thanks for coming to the conference. I wish I could be there with you. Unfortunately, I can't. We'll get through this and then hopefully I'll see everybody there next year. Today, we're going to talk about North American and global vegetable oil supply and demand trends with a big focus basically on North America. And you can't really talk about what's going on in the vegetable oil markets without talking about what we expect for capacity expansion in the renewable diesel markets. As you can see, we expect capacity to expand pretty significantly between now and the end of 2022, really, with a little bit of additional expansion beyond 2022 into 2023. There has been a little bit of additional uncertainty about our forecast after the CBR announcement, I think. And so in reaction to that, what we did is we kind of adjusted the way that we look at this, and basically we assign a probability to each plant that's been announced, the probability that they'll open. And then we use that probability to adjust our capacity forecast. But still, even with that, we expect that we will get 8 renewable plants here opening before the end of 2022. There are 5 other plants that have been announced that potentially are supposed to open before the end of 2022. But we have assigned each of those a probability of less than 50%. So it's not that they don't get counted in our capacity. It's just that we multiply their nameplate capacity by our probability, and that's kind of how we do it. So there's a little bit of downside risk to our forecast. If those plants don't open, then capacity will be a little bit lower than we expect. Either way, you can see from our capacity utilization that we expect capacity to run at about 100%. You can also see from the history that that's not necessarily what ends up happening, but in terms of our forecast for renewable diesel production, domestic renewable diesel production, and feedstock demand, we try and be relatively conservative in our forecasts. And this is that feedstock demand. You can see the dark gray is vegetable oil, which I threw DCO in with vegetable oil. I know traditionally that's kind of considered a fat and a grease, but just for the purposes of this slide, to demonstrate how much of the load vegetable oil is really going to have to carry as we go through this expansion, I included it with soybean oil and canola oil. Right now, obviously, there's not an EPA pathway for canola oil for renewable diesel to generate RINs, but we expect an approval, if not by the end of this year, early in 2022, just due to the fact that this expansion is going to require so much additional feedstock that we're going to need to use some canola oil in renewable diesel production. In addition, along the West Coast, canola oil, even though it's substantially more expensive than a lot of the other feedstocks, it will make sense for some of those West Coast refiners. The expansion of the fats and greases share of the total feedstock mix there at the end of 2022 is really a function of a reduction in biodiesel production, and then those feedstocks coming to renewable diesel. So it's not that we expect that there's going to be some new source of cows or pigs that produce choice white grease or tallow. It's just that we're shifting production out of the biodiesel bucket and into the renewable diesel bucket. And this is an attempt to try and reconcile and explain what we've seen go on with prices here this year. We have a balance sheet for crude oil supply and demand, and then for refined supply and demand. The spread between crude and RBD has gone to record levels, and I've got a chart of that's coming up. But the big takeaways from these are really the shift or the potential shift from edible use for refined oil into inedible use. And I think that's probably one of the biggest questions going forward is where does that shift occur? Based on what we think for capacity and production going forward, we kind of run out of soybean oil effectively, unless we get a big drawdown in our non-biofuel use. And to date, we haven't really seen that. We'll dive a little bit more into this when we show you the US balance sheet. But so far, because soybean oil is such a small percentage of the overall cost structure for a lot of non-biofuel products, and it's obviously such a large portion of the cost structure for biofuel, we haven't really seen the surge in prices have an impact on non-biofuel use. And in fact, non-biofuel use has been much stronger than we expected. But we think that that is going to potentially have to change at some point. And if you look at this shift, really, there's about 5 million tons of edible use that get shifted into inedible use from between 2019-20 and 2021. And here's the spread between crude and RBD. You can see it blew out to record levels in part because of a shortage of refining capacity. Obviously, there's been a lot of announcements by crushers that they're going to expand crushing capacity and refining capacity. In addition to that, we think that a lot of the new renewable diesel plants will have pretreatment or refining capacity on the front end of their plant. And so you'll get a little bit more capacity when those plants open up. However, we don't think that there's really going to be any significant relief in the refining capacity until next harvest, next fall. Really, you'll start to get some. I don't know that it will make a huge difference next fall, but certainly by the time that we get to the following fall, there should be enough capacity that's come online to make a pretty significant difference. Now, going forward, I don't think that that's going to be the end of it. I think you probably will get some additional renewable diesel capacity coming online in the coming years. And in 3 years or 5 years down the road, you'll get to this same situation where refining capacity could potentially be tight and the spread could blow out again. In the interim, I think that that RBD prices probably are going to stabilize somewhere below where they are right now, but not fall back down to the historical levels that we've seen the spread trade at. This chart shows the relative profitability of the feedstocks for renewable diesel production. You can see that UCO and yellow grease are kind of in their own category, and then the rest of the fats and greases and soybean oil kind of all trade in a clump too. I should point out this is for California, a theoretical California plant, so this includes the LCFS credit. What it doesn't include is sort of an assumption about fixed costs or variable costs or other costs. This is just a straight comparison of the value of the product, all the credits, and then less the value, the cost of the feedstock. One of the key things to note here is that soybean oil, which historically kind of traded in the middle of the fats and greases, fell down pretty sharply to the lower end of the group here earlier this year when prices really started to blow out. But with this retreat that we've seen in prices over the past 6 weeks, we've seen soybean oil kind of work its way back up to the top of that. We think that's important because soybean oil usage in renewable diesel production has been a little bit lower than we've expected. And in fact, we've cut our forecast for soybean oil usage in biofuel production over the last couple of weeks. But we think if prices kind of stabilize here around 60 cents and the fats and greases prices stabilize where they are, which is basically record levels, that soybean oil usage during the fourth quarter will probably be stronger than we've seen it for most of the year. And I'm not sure that the market is really kind of pricing that in right now. just because like we have USDA, and I'm sure a lot of other analysts have been cutting their forecast for soybean oil usage and biodiesel and biofuel production, both for 2021 and 21-22. And we think that trend may be coming to an end. Here's the same basic idea for biodiesel production. The big difference here, one, you have canola oil. You can see the relative profitability of canola oil has been really, really low in comparison to the other feedstocks. And that's basically shown up in the feedstock data. When we get it, a lot of times EIA has to mask it because they don't want to show what a single plant is using. So our sort of interpolated data on what we think canola oil usage and biodiesel production is, but that's come back and is getting closer back into profitability, but still kind of well below where it's been historically. And then you kind of have the same trend in soybean oil. The big difference is in biodiesel, soybean oil hasn't come back as far as it has in renewable diesel, and still remains near the bottom of the group. It's kind of just a little bit below DCO right now. And again, if we kind of stabilize here, then maybe soybean oil usage in biodiesel production, which has been pretty weak over the last several months, especially if you compare it to last year, again, could be a little bit stronger in the fourth quarter. For biodiesel, probably not quite. You probably don't see the same kind of gains that you might see in renewable diesel, but I think probably better than we've seen over the last several months anyway. All right, so here is our US balance sheet. You can see the big difference between our forecasts and where USDA is really center around this question of how much soybean oil is going to be used for biofuel production, and then what does that really leave for non-biofuel production. We've got a pretty substantial cut in non-biofuel, but we kind of started the 2021 season or marketing year under the same assumption. I think for 2021, I think we probably started around 11 billion pounds and have been forced to kind of raise it and raise it and raise it and raise it. And now we're up to 14.5 billion pounds. If you just go back historically over the last couple of years, it looks like the bottom in non-biofuel usage is about 13 billion pounds. I think that there will be some substitution of canola oil for soybean oil and non-biofuel usage as we get the expansion of the capacity expansion built out and the demand for soybean oil really grows. I think non-biofuel users may have no choice but to use canola oil, and I think biofuel producers may have no choice but to pay up for soybean oil. And so that kind of gets us to our number for biofuel production, which again, there's probably some downside risk in that, but even if we cut our forecast for biofuel usage, because our forecast for non-biofuel usage is below sort of the theoretical floor, it doesn't necessarily mean that we're going to be adding anything to ending stocks. And as a result, it means that the upward pressure on prices or the support for prices is probably going to continue for the foreseeable future. I think it's going to be really hard for soybean oil to trade substantially below 60 cents, say, for a long period of time. I think this last week has kind of demonstrated the market's reaction to that. Now, all of that assumes kind of crude oil prices or heating oil prices kind of at these levels, and not say 50% lower or something. If heating oil falls 50%, then obviously that changes the economics quite a bit and would change the outlook for soybean oil prices pretty substantially. The other thing to note here is that it's very hard to get this balance sheet to work without making the US a net importer of soybean oil. USDA doesn't quite go there or didn't quite go there in their August report. They've got still as a small net exporter, certainly much smaller than we are in 2021, and well below where we were in 1920. But I think if we do get this expansion, then there's a significant chance that particularly for the California market, that you could see imports of soybean oil from Argentina. Now that supposes that Argentina is going to produce enough to export. Obviously, they'll produce enough to export, but produce enough to export a lot to the United States, and that it works economically even with 19% tariff on US soybean oil imports. So this is kind of why we've had the change in our non-biofuel outlook that we've had during the year. You can see in January and February that food expenditures, both at home and away from home, or well, more away from home, were down pretty dramatically from the year before. We've recovered as the economy has recovered from the pandemic, and as the restrictions on dining have been generally loosened across the country. We expect that recovery to continue. We're forecasting big increases year over year during the fourth quarter. That's probably more to do with the year over year comparisons, a relatively low baseline for food away from home during the fourth quarter of 2020 than it is for any real big strong increase in spending. And you can see from the purple line, we've got spending going up, but just kind of along the trend that we've seen over the last several months. And then you kind of have the opposite situation in food at home, where you had relatively strong baseline last year. We've got that expanding again this year, kind of along especially in December, you tend to see a relatively big jump around the holidays. And so we've got that expanding about as much as you typically see in December, but because it was so strong last year, the year over year comparison looks a little weaker than it probably actually is. Either way, the key message here is that at least in food production, that non-biofuel demand we expect to remain robust, and obviously not all of this demand is soybean oil, but just as a backdrop and an explanation for one of the reasons why non-biofuel usage is so strong, this kind of tells that story. So this is kind of a busy chart, but this is quarterly non-biofuel vegetable oil usage by vegetable oil. And again, we include corn oil in here. This chart is one that I use in a lot of presentations. And again, what we've seen is that the numbers here, especially for soybean oil, have continued to kind of move higher and higher as we've moved through the year. There's a couple of other things that I would like to point out, though. One is that this idea that if we really do have to use a lot of soybean oil in biofuel production, then another oil is going to have to fill in. Canola oil makes a lot of sense in food production, but anecdotally, we've also heard that that palm oil is starting to be substituted in the feed industry. Now, cargo surveyor data from Malaysia doesn't necessarily reflect that yet. But given the spread, the historically wide spread we've seen between soybean oil prices and palm oil prices, I think that makes sense. And so for palm oil, I think you could probably see those numbers start to go up and potentially be a little bit stronger than we're reflecting right now. You could also see potentially canola oil a little bit stronger than we're projecting, although there have been some real problems with canola production, which we'll talk about here in a little bit. This is just kind of the same data that we saw before in terms of the profitability of soybean oil as a renewable fuel feedstock, but I thought it was interesting to compare renewable diesel production versus biodiesel production. We always think that renewable diesel production is much more profitable, and generally it is. We do a weekly webinar, and we have a different kind of profitability that we track on our website. And we had this period where the profitability from biodiesel was basically the same as renewable diesel, and even a little bit higher. And I thought it was a glitch in the data or something. I went back and looked at it a couple of different ways, and like I said, this calculates it a little bit differently than we do on the website. And you can see that that for a minute there, biodiesel was actually a little bit more profitable before kind of the bottom dropped out on it. And right now, renewable diesel is recovering a little bit better. The profitability for renewable diesel production is recovering a little bit better than it is for biodiesel, but because of the recent decline in prices that we saw before this week, obviously, the profitability for both have come back a bit. Again, renewable diesel has come back a little bit more. So the high prices, especially for RBD, have resulted in lower soybean oil usage in biomass-based diesel production. Particularly, you can see that that at the end of 2020, before prices really started to ramp up, we had some really strong usage. But then as prices started to move higher over the beginning of this year and over the last several months, and we've had a pretty significant slowdown in soybean oil usage and biomass-based diesel production. Again, I think with the retreat that we've seen from the record highs, the 70-cent prices that we saw 6 weeks ago, 8 weeks ago, I think that the fourth quarter will look a little bit different than we've seen over the summer here in these last couple of months. And we probably will get back. I don't know that we'll get back to year over year increases this at the end of this year, but certainly by the time that we get into 2022 and by the time that we're meeting again next year for the Jacobson Conference, I think that you'll see pretty strong year over year increases in soybean oil usage. And all of this has had a pretty dramatic impact on soybean oil exports. The U.S. just isn't that competitive anymore. Looking today, the shipments out of Argentina are about 4 cents a pound below where shipments out of the U.S. Gulf are. And that has just absolutely flattened out exports. We cut our forecast from, I think we started the year at 2.6 or 2.8 billion pounds, and we're down to 1.8 now, which is a little bit above where USDA is. I thought that probably 1.8 would be it, but given what we've seen in the weekly export sales reports from the USDA, I think that there's maybe another 50 million pounds that might come out before the end of the marketing year. And then again, I think that this carries through into 21, 22. I think exports are probably going to be even slower next year than they are this year. All right, looking at Brazil kind of really quickly, since this is sort of the off period for Brazil. Their crop is harvested. What we have seen is Brazilian crush has been about where it was last year, and we are expecting a little bit of growth in Brazilian crush. And so our forecast for Brazilian production, which we've got up a little bit from 2021, that could come in a little bit lower than we're expecting. If it does, that probably goes to cut exports, which the world is kind of short vegetable oil. So anywhere where we cut exports, and as you can see, Brazil is not traditionally a huge exporter of soybean oil, but they're a significant exporter of soybean oil. Anywhere that we cut exports is going to have a supportive effect on prices, because China and India are big net importers and don't really have a way to fix their situation without substantial imports of vegetable oil. And China's demand kind of grows every year because their domestic production can't keep up with the growth in domestic demand. The one thing that may change in our forecast here is for 22-23, we've got pretty substantial growth in soybean oil usage in biodiesel production. Now, Brazil just changed their blending mandate in March from 13% back down to 10%. We've got that growing a little bit again next year, but I'm not sure that that's necessarily going to happen. And so if they go back down, if they hold the 10% kind of going forward, which I think they may do, given that it's tough to see soybean oil or vegetable oil prices coming down substantially, then there could be a significantly more soybean oil available for Brazil to export next year than we're showing here. And by significant, I mean, 750,000 tons shifted from biodiesel production to exports. But again, since the world is short vegetable oil, every little bit helps. The biggest thing about Brazil next year will be their crop production this past year. Because of La Nina, they planted their crop really late, and it wasn't quite as big as everybody expected, although it still was an impressive crop. We expect that they're going to continue to expand acreage next year, and if we get a big crop in Brazil, that could be the first time that you really do see a break in world vegetable oil prices, just because of a potential fall in soybean prices. And so if you get a huge Brazilian crop, and then you have the assumption that you'll have a relatively large US crop following behind that, you could get soybean oil prices to break from 13 down to 10 or even below 10, depending on the size of the Brazilian crop and the Argentinian crop. For Argentina, you've kind of had the same thing where they've changed their mandate, and they've reduced their blending rate pretty substantially. They don't really have, they traditionally have been a relatively large exporter of biodiesel, but right now they don't really have a lot of markets where they can ship biodiesel to. It's basically Europe is the only place they can ship it to. There could be some growth there, I suppose, if Europe really phases out using palm oil as a feedstock and biodiesel imports from Malaysia that are produced from palm oil. Maybe that's some growth opportunity for Argentine production. We don't really assume that. We kind of hold biodiesel exports at the same level and hold domestic biodiesel usage pretty much at the same level. And so you see biodiesel demand in Argentina is probably the one country where it's not hugely strong, and all of that adds to the amount that they can export, which they're the world's largest exporter. So anything extra that they can export is going to help ease the situation where the world is short vegetable oils, but it's just a question of how much they're going to be able to export. Now, anecdotally, we're hearing that Argentinian farmers are not planning on planting more soybean next year. They're planning on expanding their corn crop and their corn acreage. And so if that's the case, then soybean production in Argentina could be lower, and kind of all of this gets done a little bit, and we end up cutting the amount of soybean oil that's available to the export market. And then again, like I've said several times, because the world is short vegetable oils, that would have a big impact on prices. This just kind of shows the reduction kind of over the last 5-10 years in the amount of vegetable oil that has been exported out of major countries. But it also shows that the top 6 countries are taking a larger and larger share of the exports from those major exporting countries. I think this year you could say that prices have probably forced a lot of prices in the spread between soybean oil and palm oil have forced a lot of developing countries to switch from soybean oil to palm oil. Typically, the United States exports a lot of soybean oil to small Western Hemisphere countries. A lot of that trade has shifted from the US to Argentina as US exports have slowed. But if we get this continued strength in soybean oil, especially if it's not reflected also in palm oil, I think you could get a big switch in Western Hemisphere countries from soybean oil to palm oil, and that would increase this concentration in soybean oil exports from the major exporting countries to the major importing countries. And really, we say the major importing countries, India and China are kind of in a league of their own, and then you have the other countries behind them. If you have any growth in import demand in India and China, it just kind of dwarfs up all of the other countries. So it's really focusing on what's going on there relative to focusing what's going on in South Korea or Bangladesh. All right, shifting to canola. In June, I think either the June report or the July report, USDA cut their estimate of the US canola crop by 25%. And we followed suit because of the dryness in the northern plains, canola production in the US and then of course in Canada as well, substantially below what people were expecting. We expect that crush this year will be relatively close to where we were last year, despite that cut. However, our crush relies a lot on imports from Canada. Not our imports of canola seed to crush from Canada aren't as significant a portion of our total supply as canola oil is. But it's still a relatively significant portion of the total supply. And so if Canadian exports rather are lower than we're expecting and US imports are lower, our supply of canola oil could be lower than we're expecting. We're already kind of below where USDA is, but if we don't have enough canola to crush, our numbers could be even lower. And that's important. It's less important for biodiesel production because of the things that we've talked about in terms of profitability. But it's more important for this idea that if we're going to use a lot of soybean oil in renewable fuel production, that something is going to need to kind of backfill that non-biofuel demand. And for the food industry, that's kind of canola. So we've got year over year growth in non-biofuel usage, but things kind of have to fall perfectly into place for that to happen. And we think there's probably a little bit of downside risk in our forecast, which is again below where USDA is. And this chart just shows production on the right-hand scale, domestic canola oil production, and then imports on the left-hand scale. Really what I wanted to point out here is just a couple of things, kind of the double whammy of production falling and at the same time imports are falling. But also, and it's a little bit tough to see in this chart because it's such a small portion of the overall total, but also a small increase in the amount of canola oil that we import from Australia. I think that might happen. Obviously, with shipping costs, it's really tough to make canola oil from Australia work. But I think that this is the year that there's probably some upside risk to our import forecast for US imports of canola oil from Australia, just because the crops in the US and Canada have been so bad, and because we rely so much on imports for our overall supply. All right, so Canadian canola, again, this shows what we think is going to be the result of the pretty significant reduction in Canadian canola production from where everybody thought we were at the beginning of the year. You can see we have crush in production above USDA, and not down that much year over year, just because of where vegetable oil prices are. We think that that crush will come down year over year, but not quite by as much as where USDA imagines it's going to come down. And of course, that has a big impact on the amount that's available for export. Now, USDA has higher exports than we do, in part because they have a higher carry-in than we have. The difference in our carry-ins isn't a huge disagreement between us and them on ending stocks, although I guess it kind of is, but it really has more to do with the fact we reconcile to a little bit different data series than USDA does. And so it's more about kind of looking at the year over year changes. USDA expects stocks to get tighter, and we expect stocks to be roughly the same, but at relatively low levels. I think if for USDA's export number to be true, they're probably going to have to ultimately end up cutting their stocks a little bit more than they are right now, or they're going to have to raise their crush number a little bit more than they have it right now. Our crush number is about where their crush number is. There's not a huge difference there, but our production is a couple 100,000 tons higher. And here is what the Canadian canola seed production looks like and in the yield looks like. Next week, Stats Canada is going to release their August estimate of production, and people are expecting something around 14 million tons. We had initially cut the crop to 19 million. I think now we're down at like 14.75 million. And maybe there's some downside risk to that. They did get some late rains, but I don't think it was enough to help the crop. And in fact, I think sort of, if anything, the recent rains that they've gotten in Canada are just sort of delaying harvest and not helping yields at all. So it wouldn't necessarily surprise me if 14 million tons ended up being a little bit higher than what we actually see. You can see the yield would be the lowest since 2012 and 13, but it was historically dry up there. I mean, it just didn't rain hardly at all. So I'm surprised that they have kind of any crop, but that report will be important, not only for Canadian canola seed futures, but really for soybean oil futures as well, because there's so much of their crop that ends up in the US either as imports or as canola oil. And so if the crop there is smaller than the market expects, I would expect that would drive soybean oil prices higher, at least in the short term. And so the big cut in production, and in this chart is another one that's a little bit busy. For this chart, you compare the black line with the black column and the gray line with the gray column. And our theory here really is that most of the cut in production is going to impact exports rather than crush, because of the price of vegetable oils in North America is so high. You can see what happened this year. Canadian canola seed exports started out really, really strong. And then as stocks started to tighten up, dropped well below where they were the prior year, while crush kind of remained really, really strong and actually set a record for this year, which just kind of wrapped up. The last marketing year just kind of wrapped up. And we kind of expect that same trend to continue into 21, 22. And so we've cut our crush number by less than 1 million tons from the record level of 2021, but we've cut exports by almost 50%, from around 10 million tons in 2021 to just over 5 million tons for 21-22. Again, it'll be interesting to see where those numbers ultimately come out and how much of that 5 million tons or whatever it is, 6 million tons ends up in the US, and obviously that'll have a knock-on effect for soybean oil prices down the road. Finally, Canadian biofuel feedstock mix. Now, the Canadian biofuel industry isn't as large as the US industry, and it's difficult to find good data for Canadian biofuel feedstocks. You can see basically canola oil and soybean oil are the major components of biodiesel production, with a little bit of fats and greases thrown in on top of that. We did see a shift sort of over the last several months, and the most recent data that I could find was through May. And so kind of in the same way that we saw strong vegetable oil usage in the US that kind of tailed off as we got through the spring and prices really started to rally, you saw something similar, but to a lesser degree in Canada, where vegetable oil usage and renewable fuel production slowed down year over year, and fats and greases picked up just a little bit. We expect that overall demand will be down in 2021 from 2020, in part because of the slowdown in demand just related to the pandemic, but also in part because a lot of Canadian biofuels are exported to the United States, and with the growth in US capacity and production and the uncertainty surrounding the mandates from the RFS, I think exports have just been a little bit weaker, and so that's why we've got production down in 2021. A similar situation for renewable diesel. Now you can see this is the magnitude here of feedstock demand is substantially smaller than it is for biodiesel, and substantially smaller than it is for the US, but it's mostly soybean oil, and we kind of have a similar trends going on in Canadian renewable diesel production. Now, we do have some expansion coming for renewable diesel production in Canada. A lot of it seems to be focused on turning municipal waste into renewable diesel, and there's a company that has announced or agreements to take municipal waste from quite a few municipalities around Canada and turn it into renewable diesel. But these are relatively small plants, on the order of like 1.6 million gallons a year. They do have one plant that looks like it's going to be a 7.5 million gallon plant, but that's not slated to open until 2023. And this really shows how much of the export business from Canada goes to either the US or China, and how dependent sort of the US is on Canada for a lot of its canola oil supply. I guess a different way of showing that, but also what it shows is kind of how dependent China is on Canada for its canola oil supplies. There have been some real political tensions between Canada and China, and at one point they kind of quit buying canola seed from Canada, but you can see that they haven't really slowed down their canola oil purchases hardly at all. And we expect that the cut in the crop this year will reduce shipments to both countries. And it will be important for both countries, but again, the amount of the gap between Chinese domestic production and Chinese domestic usage is pretty significant. And so even a small cut in any supplies of any vegetable oils can have a big impact on what China does. And so last year, really the beginning of the soybean oil rally was really triggered by the fact that China ran short of sunflower oil and had to buy a bunch of soybean oil from Brazil. we don't think that necessarily the same thing is going to happen here, but there is some potential for that. And given the amount of demand for vegetable oils from the expansion in renewable fuel capacity, any sort of bullish influence, additional bullish influence from the rest of the world will just add on to that upward pressure on prices and potentially drive prices again above where we above where they went earlier this year. All right, so here is our soybean oil futures trading range forecast for the next 12 months. Well, this looks a little short of 12 months. The rest of the 12 months kind of looks about where May is. In general, we think prices probably trade within a range kind of between 60 and 65 cents over the next 12 months. It doesn't mean that they'll exclusively trade in that range, just like we saw last week where prices dropped down below 60 cents for a relatively short period of time. That can happen. We also think the prices could trade above the upper end of the range for a short period of time, or potentially a longer period of time if there are production problems in South America, or again, depending on where the Biden administration releases the mandates for 21 and given what we've seen so far in the reports, probably more importantly for 2022, then maybe this forecast shifts upwards a little bit. But also given the fact that we really see a significant slowdown in demand as soybean oil gets up towards 70 cents, we think that it will be harder to get prices to go up than maybe it would seem, and certainly harder to get them to go up, I think, than it was over the last 9 months or so. For canola oil, this is kind of a different story. We think that that the crop losses in the US and Canada mean that canola oil definitely has a chance to set records this year. Over the last couple weeks, last 6 weeks, we've seen canola oil prices in Los Angeles, which is where we quote canola oil prices, kind of fall below 90 cents, which had been support for much of the summer. They've recovered obviously this week and have moved back up above that. But I don't think we're at the point yet where we're really feeling the impact of the shortfall in the US crop or the Canadian crop. And so we think that over the next 12 months that there's a real chance that canola oil prices could top $1.25 per pound. And so if you're an end user of canola oil, you should just be aware that there's a real potential for canola oil prices to go to places that we haven't seen even this year in the coming 12 months. All right, and with that, I will open it up for questions.
All right, if anybody has any questions, go ahead and raise your hands. I got to get you a mic so Tori can actually hear you. All right, right back here.
Hey, Tori, this is Peter Burley. We actually talked last week on the phone. I'm with Emerald Biofuels. Quick question. In your slide, renewable diesel profitability, I think I saw yellow grease and UCO up at the top. I'm wondering if you know offhand what CIs you assume to create the graph.
So I don't remember exactly offhand what the numbers were. The way that I did it is I looked at all of the approved pathways for the LCFS program, and I just took an average of all of those. So I don't remember exactly, Peter, but I can kind of send you what I used here after the conference is over, so you can kind of see. But it wasn't. I didn't assume anything crazy. I assumed sort of the average.
Good. I sent you an email about this already too. If you could just answer that, that'd be great. I'm guessing your UCO is around 20, and I'm guessing your yellow grease is around 30. But I'd love to see what you use. Thanks.
Yeah, I think if I, and this might be off a little bit, but I think they were like 22 and 27 or somewhere in there maybe. But I'll send you the exact numbers.
Thank you. All right. Any other questions? Got a question over here?
Hi, thank you for your presentation. How those numbers that you predict change if we have a renewable diesel pathway for canola?
So we do assume the approval of canola for renewable diesel production either at the end of this year or at the beginning of 2022. And this is kind of the way that it works out. What we do is we look at a list for renewable diesel. We look at a list of all of the plants and we make some assumptions about what the feedstock mix is at each plant. And then we go through and we predict monthly domestic renewable diesel production. And based on those feedstock mixes, then we generate sort of soybean oil accounts for this much, canola oil accounts for this, or canola oil or fats and greases or whatever account for this much and this much. Then what we need to do is we need to go back and make sure that those numbers actually work in the balance sheet. So we go through each of the fats and greases balance sheets to make sure that the numbers actually make sense from an overall supply and demand perspective. And when they don't, and they don't because everybody wants to use low CI, but the truth of the matter is there's not going to be enough low CI for everybody to use, then we go back and we start to substitute in soybean oil or canola oil. What we do is, in general, because of the economics of canola oil, we don't really use it that much in the Midwest starting in 2022. We do use it a little bit in some of the West Coast plants. So our forecast already includes an assumption that we will get an approval. If anything, I would say that the numbers probably would come down a little bit from our forecast just based on the exact timing of that approval, because we kind of assume that starting on January 1st, 2022, that the approval will be there. If it's not there, then there's some potential downside risk, but it's kind of already built into our forecast.
Got another question here for you, Tori.
Okay.
Earlier you spoke about the shortage of refining capacity for the seed oils. Do you guys, well, one, you basically showed all seed oil that was not exported from the U.S. is being refined in the table. So do you have an idea of above kind of 20 million pounds? I think you were showing. I forget what the metrics were, but do you have an idea of how much additional capacity already exists beyond what you showed there? And then do you guys track projects for adding seed oil refining capacity the way you do for the RD manufacturing capacity?
We do. So we track what we think refining capacity is, and it's a relatively closely guarded secret, but we've got a secret weapon in Ryan Kapp that maybe some of you have met at the conference. He's there at the conference. He's been relatively good to get some of the bigger companies to let us know kind of what their refining capacity is and what we expect their refining capacity to be as they expand. And so we keep track of that. The interesting thing, though, is that even if we max out what we think the ultimate capacity is, it still kind of falls short of what USDA tells us gets refined every year. So there's a little bit of additional capacity. I think some of it comes from, again, maybe some of the renewable diesel plants. And I think that part will probably grow as more renewable diesel plants open up. We think that potentially that could be 5.6 billion pounds a year. But we also keep track of the plants that are going to open or expand their capacity over the next couple of years.
Any other questions? Do they publish that, Tori?
We don't publish the list just because the industry does guard the secret so closely. We don't really want to make anybody angry. We do have a report where we talk about what we expect in terms of the capacity expansion and the impact on the market that we wrote a couple of months ago. And George, that's probably still available on the website somewhere, isn't it?
Yep, still on the Jacobson website.
Yeah. So if you ask George, George can point you to where that report is. But we don't share the list just because, like I said, the industry doesn't really like to share it with us, and so we don't want to make them mad.
I think we have time for one last question. Anyone over on this side of the room? All right. Tori, I think that's all. Thank you so much, Tori.
Thank you, everybody. Enjoy the rest of the conference.
Okay, so we have about a 15-minute break coming up, and then we have John Cusick back here.